In this video, we're going to be talking about how many days out we should be selling these options. So let's jump into it. So we're going to talk about something known as days to expiration. This is known as DTE. So these days to expiration range anywhere from 0 days, as in they're expiring today, all the way up to a few years. So we're going to bring back our little sliding scale here. So we're going to put 0 days here and 3 years here. What we personally do, and based on the strategy, this is going to vary significantly. And I know this is not drawn to scale, but pretend this is. We're going to say this is 45 days to expiration. Because we're option sellers, we like to stay in the sweet spot of 0 to 45 days. All right, because anything past this, theta decay is so low that as option sellers, we don't make much money. And this is a terrible place to be as an option seller. However, if you are an option buyer, I think this would be a great place to be because theta is not working against you. Now, if you remember, theta stands for time decay. So every single day that passes, the options price goes down in value. And that's good because we're selling options, remember? We're selling to open and we buy to close after the option price has gone down in value. So theta is our friend. So the best place to get theta decay is between the 0 and 45 day to expiration. So let's go deeper into this. We have the 0 days to expiration, and then we have the 45 days to expiration. So I personally love staying in this range right here. 45 days, you get the best theta decay here. And then here you trade for more urgency. As in, you know that you want to get assigned a stock, right? Let's say you have put options. You have too much cash, but you want to own the stock at that certain price. Going lower days to expiration is better because this gives you a higher probability of getting assigned. So if this is a put option, you would be forced to buy the stock because again, it's 0 days to expiration. So if you're in the money, that means you'll be forced to buy the stock. Similarly, if this is a call option, you would be forced to sell the stock. And so this all comes down to urgency. How urgently are you trying to either buy the stock if it's a put option or sell the stock if you're selling a call option? Now, if you're not really making an urgency play, a good place to be is in the 45 delta range. Again, this is where theta decay is just starting to pick up, and so you're able to collect a lot of premium for doing this. Now, based on how much capital you're managing or how much ever money you have in your investment accounts, you can actually use this kind of as a sliding scale. And so again, here's the urgency, and I should also add this is higher premiums on this side. And so the longer you go out, the higher the premiums you get. So there's that as well. Based on how urgently you're trying to trade, you would go lower days to expiration. If you're trying to go and get more premiums, you would go longer days to expiration. There you go. So choosing days to expiration is very important. It really depends on how urgently you're trying to execute your trade versus how much premium you want to collect. And it's just a sliding scale, so you can kind of decide where you fall into it. What I personally recommend is if you're not urgent, I would just go 45 days, keep it very simple. But once you start getting the hang of it and you want to get a little bit more involvement, you could go and tweak it accordingly. Awesome. I'll see you in the next video.